Welcome back to All Things Money. My name is David Blain, and on today's show we're talking about the portfolio construction process. This is a very important topic that does not get a lot of emphasis, in my opinion. Most people are focused at the micro level. What stock should I pick? What bond should I invest in? Should I buy a CD? Should I put my money in a bank? These type of what I call micro decisions. And not enough time is spent on the large strategic decision of actual portfolio design and construction. And this is actually the most important part of an investor's success, is how the overall strategic portfolio is constructed. So when we left before the break, we were talking about the fourth component of portfolio construction. The first we talked about was risk tolerance, the investor's willingness to assume risk. Then we talked about their capacity to assume risk, their ability to assume risk. Then we started talking about the return, and most investors have a desired return, their expectation for return. And so the fourth component is what we call the return requirements, or the needs of the client. So let's say you're 50 and you'd like to retire at age 65, and you have $1 million in your investment account. And you have a need to be able to retire at 65. You need to earn, let's say, 8% per year until you retire so that you can retire comfortably. So that's your return needs. And you can use a sophisticated planning software like we do to try to ascertain these. Or there are, you can do some online calculators to figure it out. But suffice to say, there's some sort of return need that you have. Let's say you're 80 years old and you have $20 million and you live in a house you bought in 1950, no payment, no bills, no anything. You have more money than you will ever spend in your lifetime. And so if your goal is to just meet your living expenses for the rest of your life, your return requirement is very low. In fact, you almost have no return requirement because the likelihood you'll outlive your money is very slim. Now, that scenario is very unlikely. Most people, when they have that money, their goal is to give it to their children or give it to their church or their college or something like that. And so it's a very, very rare person that has no return requirement at all. However, if someone has a lot of wealth, their return requirements can actually be much, much lower. So we take these four components: the investor's willingness to accept risk, their ability to accept risk, their return desire, and their return needs. And these four things go into the process to design the portfolio. What mix of stocks, what mix of bonds, what mix of real estate, what mix of commodities, gold, oil, what have you, do we want to put in this portfolio to try to achieve those four competing goals? And the investor that walks in where all four of these line up, they have a high capacity for risk, they have a high ability to assume risk, they have a high return expectation, and they have a high need for return, is like the perfect client because they all line up together. Well, I'm here to tell you that whether they're a client of ours or you sitting at home, the likelihood that all four of these line up is very slim. And so now we start to get into the art of portfolio design, is where do you make the trade-off? Do you reduce your return expectations? Do you reduce your return requirements? Do you take on more risk than maybe your ability to do so, or do you take on more risk than your willingness to do so? This becomes a very difficult process, and this is the key to it, though, because as markets either go up rapidly or go down rapidly, and it seems like there is sort of no normal return in the markets. It seems like things are always either going up very rapidly or going down very rapidly. So where do you make the compromises? If you compromise on the return side by taking on less risk, then you may not achieve your goals. You may have to work longer, or you may not be able to make that $1 million donation to your college. So do you take Do you cut back on your goals? Or on the risk side, if your risk tolerance says you're very risk averse, do you go ahead and step outside of your comfort zone and take more risk than maybe we think you ought to? Or your ability to assume risk. Let's say you have, many people that are dependent on you. Maybe you have a wife and children and your parents. You're supporting your parents. Do you go ahead and move outside of your ability to assume risk and take on more risk? Maybe you have a high desired return. Maybe that you have to scale that return back. So you see this is a give and take between all these factors. And it's been my experience that when it comes down to it, one of the most important parts of this, and unfortunately the hardest one to figure out, is people's risk tolerance level. That when markets start to go down, people's portfolio statements start to go down, they start to lose money, that risk tolerance for most people takes precedence. That they're like, look, I don't care, I'll postpone retirement, or my return expectations, I'm going to lower them, but I just can't tolerate the volatility of the portfolio. So when designing your portfolio at home, be cognizant of that when markets are going up and things look rosy, the temptation is to take on more risk than you have the capacity for, or maybe the willingness for. There are some people that are very strong-willed and have iron stomachs for this, but most people, you need to pay attention to that tolerance for the risk. Well, we're coming up on another break here. When we come back in the final segment, we'll wrap up this topic. For All Things Money, I'm David Blain, and we'll be right back after a few short messages.